like to talk to you all about what's called in our business, the Great Rotation. And to kind of orient you for that, currently at Kanaly, we're looking at a couple of key investment themes. We've got slow but steady growth and improving prospects for the second half of this year, whether you're talking about emerging markets. Europe does remain in recession, but doesn't appear to be rolling over. And U.S. is showing some key strengths. The Federal Reserve is preparing to normalize monetary policy. Looks like the bond buying is going to start to taper off. Big date coming up, September 18th. It's not on your calendar, but if you're watching capital markets, it's on everybody else's. It's unlikely, however, that you're going to see a major rate rise from the Federal Reserve probably before 2015. But it is likely that you should be looking at the prospect that a 30-year bull market in bonds could well be over. The question will be, will rising interest rates damage the economy, and what are the asset allocation implications for a rising interest rate environment? It's been 30 years since we've had one. So the bull market in equities remains intact. Perhaps earnings are going to accelerate in 2014. Stocks look fairly valued here, but emerging markets are cheap. So if you have some patience, perhaps that's an opportunity. But the thing I want to talk about today is the potential for the great rotation from bonds to stocks to begin fairly soon. So let's talk about great rotations in history. The first one, of course, as we all know, is the wheel. Bill Boyar was there, a great witness to it. Sadly, it was his first lesson in, intellectual property. He did not get the rights to it. It's a lesson he's never forgotten and why he's such great counsel today. The next great rotation was brought to you by your heretics, Copernicus, Galileo, and Kepler, the heliocentric universe. There was a time, of course, when we did not believe in the heliocentric universe, and we now know that great rotation exists. The next great rotation, in these parts, it's king, baby. It's the tricone drill bit. And if you don't think some fortunes have been made on this great rotation, you are mistaken. This is big medicine in this country. And the next great rotation, of course, is Elvis. With all due respect to Miley Cyrus, this was the first great rotation. All right, so what am I really talking about here? So very recently, if you measure the cumulative net flows into equity versus bond mutual funds, just using this as a proxy, since 2008, if you look on the chart, even though it's in red, you've had a positive net inflow into bonds and a fairly significant negative equity inflows recently. Now, why is that? Well, if I look at history in this chart, what we're looking at is the Consumer Price Index and hourly earnings since 1965. Hourly earnings are in red, Consumer Price Index is in blue, purple, whatever you want to look at. And if you look at this series, you can see we went through a very significant inflationary period from, say, 65 through 1980. And then since then, you've had significant decline in the average rate of either hourly wages or the CPI. At Kanaly, it's our feeling that it's really hourly earnings that drives the inflation rate. So when you see a chart like this, is it any wonder that you have a chart like this, which is the 10-year Treasury for the last 30 years, which is my career. And thank the Lord, because I used to buy the fixed income at Kanaly. So you can see why Drew was a genius. And so what this tells you is around 1983, the yield, the total return on the 10-year Treasury peaked just above 15%. And ever since then, it has been in a steady decline, hitting a low of like 1.43% just last year. And you can see at the end of this series a little slow rise in the rate. But you can look at the series and say, well, it rises and falls over time. What's the big deal about this most recent rise? Well, the thought at Kanaly is this. This is a 30-year megatrend. And the Fed has been holding interest rates at zero for quite some time and will continue to do so. To us, this is probably the beginning of the end in this 30-year series in interest rates. So the question, or the thing I want you to take away from here today, is as long as the Fed is setting interest rates, you can expect rates to stay this way. But as the Fed begins to take out or taper, meaning they're going to stop buying bonds, who is going to buy the bonds as we go forward? And what we all, I think maybe not all of you, but some of us forget, is all this is determined by supply and demand. It's set in the marketplace. So who is the marketplace that sets the interest rate? So this next slide is the ownership of marketable treasury debt. And in pink, you can see that our friends abroad own about 27% of it. Interestingly, Japan and China vie for the next position at about 10% each. Financial institutions own about 24%. What's interesting is that the top 10% is households. Everybody in this room, you only own about 10% of the outstanding treasury debt, and then monetary authorities only own about 15%. Now this is interesting because the monetary authority lately, the last say 3 or 4 years, has been 70% of the bid in current treasury auctions. What does that mean? Well, it means they're setting the price. And that's why interest rates are so low. So I'm challenging you all to think about when 70% of the bid in current auctions goes away, who is going to buy it? So let's look at history. This is a little busy chart, but what's instructive about it is it shows you the ownership trends of marketable treasury debt over time, going back in this series to 1999. And what I want to impress upon you is the players move around over time, and that has an effect on what the price of the debt is. And recently, at least in our parlance and in what Kanaly does for a living, it's been known as a fear premium in Treasury securities. We've been so concerned about stock markets, trouble around the world. Money has flown into Treasuries out of what we call the fear trade. When that fear trade begins to go away, who will be buying the treasuries? When the Federal Reserve stops buying at $85 billion a month, who will buy the treasuries? Now, I don't know about you all, but I'm pretty sure my clients are crystal clear that I'm not going to fog into a 1.5% 10-year treasury for their retirement. I'm reasonably certain that's not going to work. And so as we go forward, that's going to become more pronounced in our view. Ownership of corporate and foreign bonds. So in this series, you can see it's a little bit more diversified in the ownership. You can see that insurance companies own a very large percentage of it. Households, very, very significant portion, much more so than the treasury debt. Foreign owners of treasury. You can see this is a far more diversified market. In looking at ownership trends, the one thing that's troublesome in this trend when Kanaly looks at it is that red line of the mutual funds. I think it's more than just a phenomena of mutual fund participation. I think it's actually people chasing yield, and they're using it in the form of mutual funds. And if this great rotation begins to happen, it will be a more pronounced rise in rates as let's just say the average person looks at their statement quarter after quarter losing money in bonds. They're probably going to make another choice. And I'm suggesting to you, you might want to be in front of this one. So this is the ownership of municipal bonds. And what should jump out at you right away is households own either in mutual funds or outright securities the lion's share of municipal bonds. It is really not institutionally owned at all. And it's no surprise then that recently the municipal bond market has become very, very what we call inefficient, price inefficient. You can actually buy a municipal bond that is tax-free It's AAA, and it will have a better yield, okay, even before tax than you could buy in a comparably credit-wise in a treasury or a corporate bond. Why? Because it's such an inefficient market, and everyone reads the headlines about Detroit. The United States is not Detroit, okay? It is Fort Stockton, California, but there's a lot more municipal credits out there. And if you look at the time series of ownership, you can see, look at that big change from mutual fund ownership to outright ownership. Why did that happen? The Detroits of the world, they didn't know what was inside of the mutual funds, so they decided to own their own securities instead. I'd say it's a pretty wise move. But the point of the matter is interest rates are certainly going to be set by Fed policy. It's about to come undone, and then markets are going to begin to set the rate on the margin. You're going to actually have what I said I wasn't going to say, but I'm going to do it anyway last night, price discovery in the marketplace. When you have a bidder setting 70% of the price, there is no discovery in the marketplace. When that bidder goes away, and the bidder is going away, probably starting September, then you're going to have a new price discovery marketplace. And you'd be wise to be thinking about interest rates being set at the treasury level, at the corporate level, and at the municipal level, without even saying about what the spreads and credits will be going forward. All right, so where's some evidence, Drew? Show me what's going on out there. So these are bid to cover ratios at treasury auctions. What is that? Well, we're actually going into the marketplace and looking about what the level of interest is as each auction comes out. So what you can infer from this chart is as you see those lines go up, the level of interest is rising in each auction. You have X number of bidders to cover the amount of paper every time. So you get to ratios of almost 4 times interest, the amount of paper available, and then suddenly it starts falling off the table. This is an example of what has already happened in the marketplace. So this year, we started the year, 10-year Treasury is about 1.75, let's say, and today it's knocking on 3%. In percentage terms, that's a long way. And it can go a lot longer. And if these bid to cover ratios deteriorate more, okay, the fear trade is going to turn into another kind of fear trade. And that will be a fear of owning longer dated paper. And if you're an owner of longer dated paper, whether it's treasuries, municipal bonds, or corporates this year, it's a money losing deal. Now, how long can this last? I don't know. You know, big changes either happen a significant traumatic event or over a long period of time. So it's going to be one of those two outcomes most likely. So what are we doing at Kanaly? Well, I have one more slide. So will a rising rates derail a stock market? And what this series, what this slide says to you is, let's zero in on 1987, where we had a change of at least 15% in the long-term bond. What happened 126 days later in the stock market and 252 days later in the stock market. And you can see with the exception of 1987, you still made money in stocks in the long run despite a significant rise in interest rates. Still, we haven't seen an unwind of a Fed policy like this or a trend of 30 years. So I'm not saying this time it'll be different because we all agree we wouldn't do that today, but it's worth watching, and I think the biased in portfolios should begin to gravitate this way. So at Kanaly, we're going to avoid long duration fixed income strategies. For our municipal bonds, we're less than 5 years. We utilize some funds out there like the Double Line Total Return Fund that has a duration of less than 2 years. We're swapping interest rate risk, meaning going away from the Treasury towards credit risk in hopes that through selective management you can go down in credit quality, pick up some yield, and actually insulate yourself from a rising interest rate environment. To follow that, we're going to invest in actively managed, unconstrained strategies, floating rate debt, high yield corporates, convertible bonds, and have the ability to short. So you need to consider reducing your fixed income allocations, look at long and short strategies, and absolute and non-correlated strategies. And I want to add to that at Kanaly, for our clients that are in a position to do so, I mean, you're going to see them in private equity. You're going to see them in real asset plays. All this is going to work out very nicely for them. But this is a real watershed moment for asset allocators like Kanaly, and I really encourage y'all to consider this very strongly, in your portfolio and what the implications are. We live in the risk management world, and so when I look at all these charts and what's happened for 30 years professionally, I think about one of my favorite risk management tools is going away, and we've got to think about something else going forward. Thank you.